My name is Nikki Young, and I'm a financial advisor with Northwest Financial Advisors, which is a wholly owned subsidiary of Northwest Federal Credit Union. And I'm pleased to welcome you to this important webinar, Securing Your Retirement, Transforming Social Security into a Winning Retirement Strategy. Before we begin, I want to be clear that this presentation is general in nature and may not address every single issue or scenario that you may have. We will have a brief Q&A at the end to provide you with an opportunity to ask questions. However, in consideration of all attendees, specific, unusual, or complex inquiries are going to be better suited for a personal consultation. There is a PDF of the presentation in the handout section on the control panel, as well as a troubleshooting guide if you're having any difficulty hearing the audio or viewing the slides. Please also be advised that this presentation is being recorded for the purposes of sharing the content after, but all attendee questions and comments will be removed to protect your privacy. So we're going to start with a short history lesson on the roots of Social Security. Then we'll cover where Social Security stands today and some of the pressures that the program faces. The bulk of our session is going to be spent on understanding and maximizing your Social Security benefits, and then we'll wrap up by answering a few questions. It's important to understand where we came from with Social Security in order to understand where the program is today. It was signed into law in 1935, and at that time, President Franklin Roosevelt signed it into law, and it was really born out of the Great Depression. So we had the post-stock market crash of 1929, the Great Depression followed that, and with that, a lot of retirees, when they got into retirement, they didn't have a safety net. And so Congress realized that without some sort of Social Security, people would be living in poverty. The first taxes were collected in 1937. Regular ongoing monthly benefits started in 1940. And here we are, 80 years later, Social Security is one of the most successful programs in U.S. government history. People always ask who was the first person lucky enough to receive ongoing payments. That distinction goes to a lady by the name of Ida Mae Fuller of Ludlow, Vermont. If you happen to ski, you may be familiar with the Ludlow, Vermont area. Myself, I grew up in Louisiana where extremely warm weather is just the way of life. So I don't ski, but I do hear that Ludlow is quite a nice area for that. And you'll see in Ida's case, she lived to be 100 years old. Keep in mind that Social Security is going to pay you out for the entirety of your life. So she was a legal secretary, retired in 1939. And you see her smiling, holding a check for $22.54. I don't think any of us would be smiling with that amount, wouldn't pay for our gas from Fairfax to DC. But in terms of today's dollars, that's a little bit over $400. So back then, in terms of a monthly ongoing payment, that was a pretty good amount. And also, during her lifetime, Ida only paid in $25 into the program and ended up collecting over $22,000 back. So pretty good investment. And I think because she was such a successful case, and I'm sure there were others, is why we still have Social Security around today. So here are some interesting statistics on the past, present, and future of Social Security. Today, 65 million people are currently receiving benefits. That includes 9 out of 10 people 65 or older. Social Security benefits represent about 30% of income of the elderly. And among that elderly benefit base, 50% of married couples and 70% of unmarried persons are receiving half or more of their income from Social Security. Now, it's important to note the changing demographics and life expectancy of the benefit base. By 2035, the number of people aged 65 or older will increase to over 76 million from 57 million today. And since 1940, average US life expectancy has increased by 16 years, which brings us to where Social Security stands today. I know that there are a lot of clients and individuals out there that say, hey, I think I should take my benefit as early as possible because I don't think it's going to be around. And there's real concern there. And while I do think that there's truth to Social Security being in trouble, I know that there's truth to that. I do think that it will be fixed. And a lot of people believe that it's going to be fixed, but the question is, will it grow fast enough? And so you may be wondering why we have this issue as far as it being in trouble. And here's the reason. In 1950, average US life expectancy of retirees was 68 years old. Social Security at that time only covered retired workers, so you had 16 workers paying into the program per person receiving benefits. Now today, 2022, life expectancy is 11 years higher at 79 years old. Not only are we covering retired workers, but we're covering spouses, survivors, also paying disability and family benefits. So now we have only 2.7 workers paying into the program per person receiving benefits. So here we have the revenues that Social Security receives in green, the benefits that it pays out in blue. And what this chart shows us is that since 2010, Social Security has been paying out more in benefits than it's received in revenues. And it's able to do that because it has a trust fund of excess revenues that it was able to draw on in order to meet its obligations. Now that fund was projected to grow until last year, 2021. So if we keep on pace, by 2034, Social Security will only be able to meet 78% of its obligations. And what may have accelerated this is the pandemic. We had major unemployment numbers, and when you don't have people working, you are not collecting Social Security taxes. But the good news is now that we're in kind of post-pandemic, unemployment numbers are back down, so that is more people paying in. And now those were the challenges, and I know that it's concerning. However, there are a number of proposals out there to strengthen Social Security, and again, I do believe that it will be fixed. Even as dysfunctional as our current Congress can be, it's extremely unlikely that they're going to let the system go dry. We all have a stake in this. Contrary to legend, members of Congress do pay into Social Security. So, and for the past 80 years, this program has been one of the most popular and successful in our history. But in order to strengthen it, they will need to make some changes. And what will that look like? So again, there are a number of proposals. In the interest of time, I'm not going to go through all of these here. But if I had to highlight some of my favorites or some of the ones that I think that are most likely to go through Congress, I would say that Congress is going to raise the full retirement age. The last time they did this was in 1983. They raised full retirement age from 66 to 67 for anybody born in 1960 or later. So now they may say, okay, if you were born in 1970 or later, full retirement age is now 68. And that's one way to fix it. Another discussion topic is increasing the payroll tax cap. The way that works is you pay Social Security tax on the first $147,000 of income that you earn. And you see that on your deduction on your pay statement every few weeks. And so what this proposal would do is it would keep that in place. You would still pay your Social Security tax on $147,000 in income. Then you would get a break, let's say from $147,000 to $400,000 in income. And then once you meet that $400,000 in income and beyond, the tax would pick back up from there. Lastly, reducing benefits for high income earners. The rationale there is that individuals such as Warren Buffett or LeBron James don't need their Social Security tax. So that's one way that would bring money back into the program. I don't think that it will be one policy change that's going to fix the problem. It may be a combination of what you see here. And also remember, all of this has to go through Congress. And given some of the global issues that we're dealing with right now, it's kind of been put on the back burner, but these are the discussion topics in terms of strengthening the program. While Social Security plays a very important role in our retirement income, it is important to remember that it was never intended to be more than supplemental income. You can see here that the average Social Security retirement benefit is a little over $1,657 in 2022 on a monthly basis, and that's a little bit shy of $20,000 a year. Lower income earners will receive a greater percentage of their earned income in Social Security benefits, and once you reach $75,000 in earned income, Social Security benefits are only going to replace 41% of those earnings, so that's about $30,000. The higher your income is, over $75,000, the more replacement percentage decreases. And it's important to keep in mind, because now Social Security will tell you that this was never intended to be your only source of retirement income, and that will most likely need other savings in order to have enough money to live comfortably in retirement. Before we get into the details, I do want to mention that Social Security is subject to a cost of living adjustment, or a COLA for short. And what that represents is a potential increase to your benefit every year. And the COLA is calculated based on the changing in prices year over year, also known as inflation. And we have that so that way we don't lose our purchasing power of our benefit over time. Right now, as you know, we are in a period of higher inflation. So 2022, we had a much higher COLA. In 2016, it was zero, but it will never be negative even if prices do end up decreasing. So now that we've talked about the roots of Social Security and where the program stands today, let's get into the meat of the presentation, which is understanding and maximizing your Social Security benefit. So what makes someone eligible for Social Security, and how is it calculated? You must have worked and paid into the program for at least 10 years. Your earnings are restated in terms of today's wages to reflect wage growth. They take your highest 35 years of earnings, average them, divide by 12 to arrive at what's called your average index monthly earnings, or your AMI. This is not something that you need to calculate by yourself. Social Security will do it for you. It's on your Social Security statement. Then they apply a Social Security benefit formula to your AMI to produce the primary insurance amount. And that's the important number, because your primary insurance amount is the amount that is payable to you at full retirement age. Full retirement age may seem like a straightforward calculation, but it does vary depending on your year of birth and can affect the amount of benefits that you receive. So as I just mentioned, the full retirement age is the point in your life where you will receive your full unreduced Social Security benefit amount. And based on your year of birth, your full retirement age is going to be anywhere from 66 to 67 years old. And if you were born in 1960, that's significant, because those are the people that are turning 62 this year. And that's the earliest that you can claim Social Security, age 62, with the latest you being able to delay being age 70. So if you decide to go ahead and claim your benefits at age 62, you will receive a reduction in benefits. You're going to, depending on your year of birth, you're going to receive only between 70 and 75% of the benefit that you would have received at full retirement age. And this is a permanent reduction. A lot of people have an incorrect idea that if they claim Social Security early at 62, once they hit full retirement age, that number is going to magically pop up to the full amount. It will not. So if you make that decision to claim your benefits early, which may be completely appropriate for some people, just know that that benefit is going to be reduced permanently. Alternatively, if you decide to delay claiming your Social Security after full retirement age, up until age 70, you'll get an increase, which, depending on your year of birth, will be anywhere from 24 to 32% of your benefit amount at full retirement age. Despite some of the benefits of either waiting to full retirement age to claim or delaying until 70, 31% of men and 34% of women claim Social Security early at age 62. These are the most important factors to consider when making your decision on when to file. If you need the income, if you're 62, maybe you're not working, and there's a legitimate cash flow need, then it may be a good decision to file. This is your benefit. You've paid into it. This is what it's here for. Go ahead and take it. Age difference, which coincides with marital status. Married couples should consider their Social Security claiming decision as a household decision as opposed to two separate individual decisions. Oftentimes, it makes sense for one spouse to wait up until age 70 to create the largest possible retirement benefit, which then can translate into the largest possible survivor benefit, and we'll discuss that in a minute. But the greater the age difference, the longer the benefit payment, and the bigger the impact when making an early election. Longevity and health. The whole idea behind waiting until your benefits are worth more is the assumption that you're going to be around to collect them. You got to be present to win. So if you have a serious health condition or based on your family history, you don't think that you're going to have the longevity, you may not want to delay. But frankly, I've found that people significantly underestimate how long they're going to live. Let's take a look at an example. Here we have an individual with a full retirement age of 66. At that age, they're going to receive 100% of their benefit due to them of $2,000. If this individual decides to claim early at 62, they're going to receive 75% of that amount for $1,500. And if they delay, they're going to receive an increase of 32% for an amount of $2,640. This is on a monthly basis. But to understand the impact, I do think that we should look at benefits on an annual basis. So using our same example, we know that our individual gets $2,000 a month at their full retirement age of 66. So that's going to be an annual payment of $24,000 a year. If they claim early at 62, that benefit amount is reduced to $18,000. And you do see the in-between years, as you get closer to your full retirement age, your benefit is reduced less. So you may have someone filing at 64 or 65 as situations and circumstances change. And then by waiting until 70, you can see that that individual's benefits will increase to $31,680 a year. So consider the difference between collecting at 70 versus collecting at age 62 in terms of total benefits collected by the time this individual is 85. That decision could be worth $42,000. An interesting note on being able to claim benefits early, it wasn't until the 50s that Congress actually amended Social Security law to even allow people to claim benefits early. That was originally only intended for spouses, but then they extended to everyone with a catch. Yes, you can file early, but you're going to get a reduced payment and it's going to be reduced for the rest of your life. So taking payments early is tempting, and it's true that each of you is going to have your own situation, your own break-even age, and we don't know how long we're going to live. So the impulse is there to start getting payments as soon as we can. But I think, as we'll see over the next few slides, you may end up living longer than you think. I did mention break-even age, and it's so interesting to me because your break-even age is the age that you would need to live to in order to make not taking payments early make sense. So using our same example of our individual with a full retirement age of 66, benefit due of $2,000 at that point, if this individual claims at 66 instead of 62, they need to live until 79 in order to receive more in benefits. If this individual files at age 70 instead of 62, they need to live until age 81 to receive more. And then finally, if they claim at age 70 instead of their full retirement age of 66, they need to live to age 84 in order to receive more in benefits. And the longer you live past that break-even point, the more in benefits that you're going to receive. And so you'll see on the right-hand side here, the total benefits collected by age 95. And if this person thinks that they're going to have the longevity, the difference in the filing decision could be a $200,000 decision that they're making by that time. Just to drive the point home on life expectancy, I want to share some data in that regard. For an individual who is 66 in 2021, if you're a male, you have a 50% chance of living to 86, 25% chance of living to age 91. Females have a little bit longer life expectancy with a 50% chance of living to 88, a 25% chance of living to 94. For couples, life expectancy increases even further. Either partner in a couple has a 50% chance of living to age 92 and a 25% chance of living to age 96. So these life expectancy numbers are going to be critical when planning for your retirement income and taking into account what we just went over with your break-even age. Besides current health, longevity, marital status, one other extremely important consideration that's going to directly influence whether or not you collect early is whether or not you're actually retiring. There are individuals who claim Social Security at 62 and then they're still working. And that's significant because of a rule called the earnings test. Social Security benefits, they're intended to be supplemental retirement income. So the administration wants you to be retired before you actually collect them. And if you're not, they will penalize you for earning above certain thresholds. So let's take a look at what those are. If you are under full retirement age and you're working and you earn more than $19,560 for 2022, those limits do change year to year. What will happen is $1 of benefits will be withheld for every $2 in earnings above that limit. The year that you reach full retirement age, that limit does increase significantly to $51,960 a year. And what will happen is $1 of benefits will be withheld for every $3 in earnings above that limit. And this takes a look exclusively at earnings from salary. And once you reach full retirement age, you can earn as much as you want and you won't be penalized at all. And this applies to all retirement benefits, your individual benefits, your spousal benefits, child, survivor, any of those collected before you reach full retirement age. Let's take a look at how these rules could apply. Here we have the Smiths and the Sullivans. As we just went over, if you're working and you're earning above a certain limit and taking Social Security early, you're going to get a reduction in those benefits. So the Smiths, they're age 62. They're each entitled to a benefit of $10,000 each. But Mr. Smith decides that he wants to go back to work, and now he's earning over the limit. What's going to happen is his benefit is going to be reduced to zero. Mrs. Smith is still going to receive hers, but now they're only going to receive $50,000 in total income instead of the $60,000 that they were hoping for. On the other hand, we have the Sullivans. They are full retirement age, so they can earn as much as they want and it won't penalize their benefits. These are the type of calculations that you should discuss with your financial advisor if you're going to be applying for benefits while you're still working. Changing your mind. If someone starts collecting their benefits prior to full retirement age and they get a little bit of filer's remorse and find themselves wanting to return to work without having their benefits withheld, you can consider a request for withdrawal of application. It essentially allows a do-over, but you have to do this within 12 months, 1 year, from when you first started receiving your benefits. You would file this form. It's called the SSA 521. You do have to repay all of the benefits that you've received up to that point, but then you get to start over. And when you do this, you can go back to work, and then when you reapply, it'll be as if you're doing it for the first time. And then your Social Security will recalculate your benefit based on your revised work history, and you're only allowed to do this once in your lifetime. Keep that in mind. So far, we've discussed the drawbacks to collecting early or working when you're collecting benefits. Let's switch gears to show what will happen if you wait to collect benefits. You're going to be awarded a guaranteed increase of 8% a year for every year from full retirement age up until your age 70 that you delay claiming your benefits. So for someone with a full retirement age of 66, that's 4 years until 70, 8% a year, that's a 32% increase. For someone whose full retirement age is 67, 3 years till 70, 8% a year, 24% increase. And I gotta tell you, there's no place else that you are gonna get a guaranteed risk-free return of 8% a year. But if you're gonna be waiting to claim a larger Social Security benefit, it may require that someone draw on an investment portfolio in order to bridge that income gap and meet lifestyle expenses until Social Security benefits are received. So you may have invested retirement assets in the form of a 401k, a TSP, IRA, another employer-sponsored plan, or you may have non-retirement investment accounts. So what this chart shows is it gives us the 3 most common filing options: claiming at 62, claiming at your full retirement age, and claiming at age 70. And what it shows is which one of these options is going to result in the greatest total lifetime value based on your expected rate of return, which you can see on the left, and your expected longevity, which we have at the bottom. So for a woman with an expected longevity of 88 years old and a consistent 5% return after fees, if we go to the intersection of that data point, we're going to end up in this blue area here. And what that says is, for her, claiming at age 70 is going to result in the highest expected lifetime benefit. Now, can she claim at age 62? Absolutely. But if maximizing the benefits is the goal, and she's trying to get to this purple area, what that's saying is that her investment portfolio might have to work a little bit harder to achieve a higher rate of return. And to do that, she may have to accept a little bit more risk into her portfolio, which may not be suitable for someone that's 88 years old. So this is a great way to see how the performance of your invested assets can impact your filing decision. So the lower your expected return and the longer your longevity, the more it pays to claim at age 70. But it's only given you have the longevity. If you don't have the longevity, the lower the life expectancy, filing early becomes the clear decision regardless of what returns are. Now let's go over some of the rules of spousal and survivor benefits. Congress amended Social Security to include a provision for spouses who may not have sufficient earnings history to generate a decent or any benefit on their own. Non-working spouses can take a portion of their spouse's primary insurance amount as a benefit. In order to qualify for the spousal benefit, the working spouse must have already filed for their benefit. Spousal benefits for non-working spouses are based on full retirement age of the non-working spouse. If the non-working spouse claims at full retirement age, their benefit is equal to 50% of the working spouse's full retirement amount. You can certainly claim early, but of course you're going to get a reduction. So if a non-working spouse claims at 62, then they may only end up with 32.5 to 35% of the benefit depending on their year of birth, and that is a permanent reduction. Now let's take a look at a sample married couple, Jordan and Alex. Jordan worked and therefore paid into Social Security, so he has a primary insurance amount of $2,200. Alex, on the other hand, does not have sufficient work history, so her primary insurance amount is $0. There are 4 key things to make sure you know about spousal benefits. The first is that a spousal benefit is equal to 50% of the partner's primary insurance amount. So for Alex, that's going to be an amount of $1,100. So what will happen is at full retirement age, Jordan can collect his $2,200 and then Alex can collect her $1,100 as well. Second, it's important to know that it's 50% of the primary insurance amount, not 50% of what the working spouse is receiving. So if Jordan decides to collect early and lock in that lower benefit for himself, that's fine. Alex can still wait until her full retirement age and get that $1,100. Third is that Jordan must file for his benefit in order for Alex to be eligible to collect the spousal benefit. So if they're both the same age and Jordan decides to wait until 70 to get that increase, Alex is going to have to wait until age 70 to collect her spousal benefit. Her spousal benefit will not be increased. There is no benefit to waiting beyond full retirement age for a spouse. That amount is never going to be more than 50% of what the working spouse is entitled to. When Alex collects her spousal benefit, is going to impact the total that she takes home. The further out she is from full retirement age, the more that benefit is going to be reduced. It will be reduced less the closer you get to full retirement age. And then at full retirement age, you'll just get the amount that's due to you, because there's no benefit for delaying beyond full retirement age or a spousal benefit. But now, what if Alex is entitled to her own individual benefit, let's say $600? The fourth thing to know about spousal benefits is that you don't get to add a spousal benefit to your own benefit. They're actually netted against one another, and the spouse with the lower benefit can be eligible for something called the spousal boost. And so let's take a look at how that works. So Alex is now entitled to her own benefit of $600. At full retirement age, that's what she'll get. If she claims early, her benefit will be reduced to $450, and then if she waits, she will get an increase to that benefit at $792. When you add spousal benefits into the mix, it becomes a little bit more complicated, because at their core, Alex's benefits are worth $1,100. So if she collects her benefit at 66, not only will she get her $600, but she's going to get a spousal boost of $500 to make up that difference to get to that $1,100 maximum that she's really eligible for. If she claims her benefit early, she gets the reduction, but her spousal benefits also get the reduction as well, and she'll only end up with $800. Lastly, if she delayed until age 70, her benefit is increased, but her spousal boost is only enough to make up that difference to $1,100. So to recap, spousal benefits are equal to 50% of the working spouse's primary insurance amount. They don't get any bigger if you wait past full retirement age. Your partner must have filed for their benefits in order for you to file for your own as a spouse. And then lastly, individual benefits and spousal benefits are netted against one another. That example had one spouse with being a much higher earner, and then the other spouse being a much lower earner or not having a benefit at all. But what happens if both spouses have a relatively similar benefit at full retirement age? So you're only eligible for either your spousal benefit or your own, whichever's higher, not both. So here we have Jordan that has a primary insurance amount of $2,200. Alex has her own benefit amount of $2,500. So what would happen here is Jordan would file at full retirement age, get his benefit. Alex would file and collect her benefit, since both of their individual amounts are greater than half of each other's. In the case of a widow or widower, there are survivor benefits that widow or widowers can be eligible for. If you are 60 or older, 50 or older, if disabled, any age, if you're caring for a child who is younger than 16 or disabled and entitled to Social Security benefits on the deceased record, you can be eligible for survivor benefits. Children can receive benefits if they are unmarried, younger than 18, between 18 or 19 if they're in school full-time, age 18 or older, and severely disabled. It is a unique case, but we have seen it where an individual is full retirement age and they have a child that is 15. That child can collect benefits up until their age 18 if they're no longer in school. Additionally, parents of the deceased can receive benefits on the deceased's earnings if they were dependent on that person for at least half of their support. It's important to know when to take survivor benefits, including what ages are best for maximizing benefits. At death, the surviving spouse will receive the greater of their own benefit or 100% of whatever the deceased spouse benefit was receiving. And if you take benefits early, you can take it as early as 60. But if you do that, you are going to receive a reduced amount. And you can see the different ages as you get closer to your full retirement age, that reduction is lower. And then once you get to full retirement age, you're eligible to receive 100% of what your deceased spouse was receiving at the time of their death, as long as your own benefit is not higher. As with spousal benefits, there's no advantage to delaying survivor benefits past full retirement age. I want to go a little bit deeper with survivor benefits because they are a critical part of the decision. There's such a planning opportunity there. Approximately half of all women collecting benefits today are collecting benefits. All are in part based off their husband's work history. So using our example of Jordan and Alex, the decisions that Jordan makes on when he's going to file is likely going to impact Alex's benefits even after he's gone. Unlike spousal benefits, survivor benefits are directly tied to what Jordan was receiving when he passed. So if he decides to collect early and get a reduced amount, that's going to translate to a reduced survivor benefit for Alex. Alternatively, if he decides to wait until 70 and increase his benefit, that's going to directly translate into a higher survivor benefit for Alex. So what your deceased spouse is collecting at death directly impacts what your survivor is going to receive for the rest of their life. Now let's address what happens in the event of a divorce. There are a number of hurdles that must be cleared by divorced persons before they can access Social Security benefits on their ex-spouse's record. First, the marriage must have lasted 10 years or longer. I know that seems like a long time, but as someone who just celebrated their 10-year anniversary, it goes by a lot faster than you think. So if you're at year 8 or 9 and you just can't take it anymore, you might want to consider your Social Security benefits, maybe get a little return on your investment. Secondly, you have to be currently unmarried. Next, if your ex-spouse needs to either be receiving their benefit or you must have been legally divorced for at least 2 years. And that's important because people always ask, do I have to wait for my ex-spouse to file before I can file for my benefit? And if you've been divorced for 2 years, you do not have to wait. Congress put that rule into place because they realized that when people get divorced, oftentimes, it's not amicable. So what they didn't want is one spouse with the earnings history to say, you know what, I'm going to show you, and I'm never going to file for my spousal for my benefits, so you can't get any benefits. That's extremely petty, but I know that divorces can be that way. So that's one protection that's in place there. Next, you do need to be 62 in order to receive spousal benefits, age 60 to receive a survivor benefit. If your ex-spouse is not currently receiving a benefit, they have to be at least 62 or have worked 40 quarters in order for you to be eligible. Stated, simply, they have to be eligible for a benefit in order for you to be eligible for a benefit. If your spouse doesn't qualify, if your ex-spouse doesn't qualify, then neither do you. And then lastly, if your ex-spouse remarried and you haven't, you're still entitled to spousal and survivor benefits of your ex-spouse. They can get remarried all they want. This is known as the Johnny Carson rule. And in his case, he was married 4 different times and divorced 3 different times. And when he was living, all 3 of his ex-spouses collected spousal benefits on his work record. And then when he died, all 4 collected survivor benefits. So that's an interesting case, but I think what's most important to take from that is that there is a safety net in place for divorced people, and not a lot of people realize that. Divorce benefits work the same as spousal in terms of the math. You're eligible for 50% of your ex-spouse's primary insurance amount, as long as it's not, as long as your own benefit is not greater than that. If you take it early, you do get the reduction, and then there's no benefit to delaying past full retirement age with that benefit. Now we have to talk about everyone's favorite subject, taxes. Regardless of when you file, your combined income is going to have an adverse effect on your Social Security benefits in terms of taxes. So a portion of your benefits will be taxable once your combined income passes a certain threshold. Combined income is your adjusted gross income. They add back non-taxable interest, which you may have from a municipal bond investment. They add in half of your Social Security benefits, and that's your combined income. Here are the thresholds for Social Security taxation. So if you are a combined, you're a joint filer and you earn less than $32,000, or if you're a single income filer earning less than $25,000, none of your Social Security benefits will be subject to tax. If you're in between $32,000 and $44,000 for joint, or $25,000 and $34,000 for single income filers, up to 50% of your Social Security benefits will be subject to tax. And then finally, if you earn more than $44,000 as a joint filer, or more than $34,000 as a single income filer, up to 85% of your of your Social Security is going to be taxable. And you know, there's this notion that when you are in retirement, you're going to be in a much lower tax bracket, so you're not going to be paying that much taxes. And in a lot of cases, that is true. But particularly for retirees that are middle income, upper income, they're surprised at how much they're actually paying in taxes in retirement. So part of the strategy is going to be, yes, maximizing your retirement income, but doing it in a way that's going to minimize your taxes, because you may have income from your 401k that's taxable, income from your Social Security that's taxable, and you may even have a pension that's taxable. So how do you put all of those pieces together in a way that's the most tax efficient? That should be part of the conversation that you're having with a financial professional. In terms of state taxes, most states either don't tax Social Security or don't have state taxes at all. But there are 12 states in the green box here that tax some or all of Social Security benefits. So good thing to note if you happen to live in any of those states or end up moving to one of those states in retirement. Social Security offset. There are unique situations where your Social Security benefits could be offset. There's the windfall elimination provision and the government pension offset. And depending on your situation, if these apply, your benefits may either be reduced or eliminated altogether. For the windfall elimination provision, this typically applies when an individual has worked for a public agency that didn't pay into Social Security, and they earned a pension from that public agency, but then they go and they work another job where they did pay into Social Security, so they are due a benefit. There's a calculation to whether or not that benefit is going to be reduced. And then for the government pension offset, that applies to any spousal or widower survivor benefits that you may receive if you also earned a pension from an employer that did not pay into Social Security. So if any of these situations apply to you, the calculations can get complex, but Social Security does have calculators on their website that can help you estimate how these rules will cut into your benefits, if at all. Here is a sample Social Security statement. Many of you may have already seen this. The statement shows the benefits that you're going to receive starting at age 62 up until age 70. So you'll be able to see the differences there on a monthly amount. And it will also show you your earnings record. Make sure that you review this periodically, because you have 3 years, 3 months, and 15 days to fix it if there are any errors. I don't know how they came up with that timeline, but that's what it is. And you'll also see your total career taxes paid, which was for me the most impactful, seeing the amount of taxes being withheld from me in a lump sum earning that way. It's in a lump sum amount that way. It's definitely a motivator to maximize your benefit if you can. As of 2018, Social Security is only sending paper statements to clients age 60 or older if you're not receiving benefits and you do not have an online account. So I do recommend you sign up for an online account. It's free and it's a quick, secure, and easy way to review your information and get your statement. When you're ready to file, you can do so either online, in person, or by phone. If you can help it, don't call Social Security. The wait times can be extensive. If you can, file online. I know there's situations where you cannot file online, so either go and make an appointment to go in person, and of course, if you must, then just be prepared with some snacks and just to put your phone on speaker if you're actually going to give them a call. I do have some action items for you. Definitely go to ssa.gov, download your statement, review your earnings history, meet with a financial professional to review a personalized analysis based off of your specific life scenario, and then incorporate the best collection strategy into your retirement plan. We at Northwest Financial would be happy to help you with your Social Security decisions as part of your retirement planning. It's part of what we do here. At the conclusion of this presentation, you will receive a survey. Any feedback on the presentation is greatly appreciated, but you'll also be able to indicate if you would like to be contacted to schedule a complimentary consultation. We have advisors, including myself, that cover our many branch locations, and you'll be able to specify which location is most convenient for you, including virtually. So that's going to conclude the presentation portion of the webinar. Before we get into questions, I do want to thank you for taking the time out of your evening to join me. Although very important, I know that Social Security is not the most exciting topic, so thank you again for joining me.